Good morning. How's this for the first scene? Happy Monday morning. It's 9 a.m. here in Hong Kong. You're watching the China Show. I'm David Ingles with Yvonne.
Our top story this morning, a cautious start to the week as the White House ramps up pressure on the Fed to cut rates. Oil prices sinking as OPEC and its allies agreed to hike output, pushing Wall Street banks to cut their crude forecasts.
Now, the offshore yuan surging as President Trump signals he is willing to lower tariffs on China, praising recent statements from Beijing as positive.
Meanwhile, incumbents score strong election victories in Australia and Singapore, with voters choosing stability as Trump's policies rock the global economy.
And Warren Buffett says he is bowing out after a 6-decade career that's rewarded Berkshire investors with returns of more than 5 million%.
Dave, I've learned now I should not go on maternity leave in a trade war because I cannot catch up on what's been going on. But yes, I've learned now, right? It's really just when you come in the morning, you read the headlines. That's really kind of the latest.
Yes.
You don't really have to catch up too much.
We actually have trained ourselves in recent weeks now not to write scripts anymore.
Just rip it up, right?
We will rip everything up.
Okay.
And it's, I mean, to the point that, what did you miss? You missed everything, but also quite nothing, if you think about what we've done so far. I've certainly aged.
You still look great.
Well, thank you.
Yeah.
Thank you for that. You still look fantastic, too. I think the only change, I'm standing now, which I guess goes into how much I've aged. Like, I have back issues now. But again, thank you for coming back. It's nice to have you back here.
Well, thank you for having me back. And I want to thank everyone that's filled in to step, in while I was gone, especially when it comes to Annabelle, Rebecca, Avril, Stephen, Ingles. It's just been a whole team. So I really, thanks for letting me stay and be with my babies.
Yeah, there we go. So 2 minutes, that's the China Show for today. We'll see you all tomorrow. A quick glance at market action right now as we go into the session today. What we've done as well to ease Yvonne back in, I've shut the markets today.
It's a public holiday.
Yeah.
Ease me in, yes.
Hong Kong is shut, the broad swathe of Asia-Pacific is shut today. There's a lot of market action, though, to get you caught up on as well. Right? So if you're waking up and wondering why the Chinese currency is where it is right now, trade optimism, the dollar is substantially weaker compared to last Friday into where we are right now. So we're trading below the 200-day moving average here on dollar China. It's not just the Chinese currency, right? We've had interventions going into the weekend. You had Hong Kong dollar, HKMA coming in for the first time in 5 years to sell Hong Kong dollars to just alleviate some of the upward pressure we're seeing across these currencies. Not on your screens, but also worth pointing out, the Taiwan dollar is also very much in focus as well. We have a rate decision coming through this week, the Fed, with the Bank of England, and we also have, speaking of elections coming through as well, we have, of course, the cardinals in the Vatican, of course, also in terms of the conclave there. Right, very, very quickly, oil is a big story today. Massive drop across the oil price complex. Equity markets are also following suit within the energy space as well. 3.5%. Morgan Stanley, Goldman Sachs out with some reductions to their forecast here. And we're looking at A50 futures coming online over in Singapore. Taiwan is coming online. We have elections, of course, coming through. We'll talk about that in a moment. And S&P, of course, is on weaker footing after a 9-day gain in the cash markets. But yes, we've shut the markets for Yvonne today.
They knew I need to come in easy because I'm a bit rusty. As you can tell, it's been 5 months, so bear with me here for the next 2 hours or so. But yeah, there you go. Hong Kong, China, Japan, South Korea, and Thailand all closed for today. Let's get to our top story, though, this morning. President Trump says he is willing to lower levies on China while repeating that any trade deal would need to be, quote, fair.
At some point, I'm going to lower them because otherwise you could never do business with them. Yeah. And they want to do business very much. Look, their economy is really doing badly. Their economy is collapsing.
An hour ago on Air Force One, Trump also said he won't be talking this week with President Xi Jinping. Let's bring in our China correspondent, Min Min Lo. She has the latest for us. It's ever-changing, it seems, that I've learned now here. So what does this all mean? Are we getting even closer to any sort of trade talks?
Yeah, it does seem like the early outreach from U.S. to China hasn't really gone smoothly, given that Trump is saying that both sides are, well, he's not going to be speaking with President Xi this week. He also says China and U.S. officials are talking about different things, and this comes as China China has said they are considering potential for trade talks. But Wall Street Journal reporting that China's securities czar Wang Xiaohong is trying to find out what the U.S. actually wants when it comes to fentanyl cooperation, and also reporting that China might be considering sending Wang Xiaohong to meet with U.S. officials or to meet with U.S. officials in third countries, which is interesting because who China feels to oversee trade negotiations is important. In the first trade war, it was Vice Premier He Lifeng. It could be He Lifeng again this time round, or perhaps the top trade negotiator, which is the Vice Minister for Commerce. But if they send Wang Xiaohong, it does indicate that maybe China wants to limit the scope of discussion to public security issues, to fentanyl, because Wang Xiaohong is the Minister of Public Security. And perhaps they still want to see certain preconditions fulfilled before they would be open to a broad-based sort of trade negotiation.
ASEAN are also joining the likes as well here in the mix. What do we know? What's the latest here?
Yes, so this is another interesting development because we have ASEAN countries as well as the East Asian countries, Japan, Korea, and China, putting out a joint statement at the finance ministers meeting in Italy, and essentially saying that U.S. protectionism is going to lead to economic fragmentation, and these countries are together saying that they are going to commit to upholding the international rules-based order and the multilateral trade system. And the finance minister of Japan was there. Obviously, he is the first one who has direct experience negotiating with the U.S., and he was sharing his assessment of the situation with the others, and again reiterating that it's important for all the countries to come together to uphold regional economic stability. And it's a sign that so far the U.S. hasn't been successful yet in trying to drive a wedge among these Asian nations to get them to come together to form a united front with the U.S. to encircle China, and understandably so, given that the ASEAN countries as well as Korea and Japan all count China as one of their top trading partners. So they are in a very delicate position here.
Min, thank you so much. Min Lo, our China correspondent there. Right, on the dollar weakness story that we've been tracking, Taiwan dollar just coming online right now, and we're now looking, the move today, Yvonne, combined with the one that we had on Friday. I'm just going to get this straight now. So the Taiwan dollar is currently on its biggest two-day jump in at least 40 plus years. So we're looking at the biggest jump since at least 1983 right now. So we'll really have more in the currency markets coming through.
You got to wonder, is it still that sort of de-dollarization trend that's really playing out in Asia, and how Asian currencies are really, trying to at least put a backstop into some of these gains, right? We saw Taiwan intervened, HKMA also selling. So I think we're going to see more of that. We have more analysis with HSBC's Joey Chu on this. She's the head of Asia FX Research. She's going to come on and explain things for us in just a few minutes.
Yeah, stay tuned for that. One coming up. There's also the oil story to get to as well. So you have the West Texas down across the board, down across the curve as far as oil prices are going here. So we've now seen quite a substantial pullback across the Asian hours. That's right. The big news, in case you missed it, OPEC Plus coming through and agreed to another bumper increase in output, and this comes with demand being challenged by the ongoing uncertainty over the global economy. Let's bring in our oil products reporter, Nicholas Lua, joining us right now to talk us through this. Nicholas, good morning. Thanks for coming on the show here. Talk us through this. Why is OPEC Plus, why is this significant given the backdrop we're seeing globally?
Right. Good morning. The big deal is that this is the second supersized increase that OPEC has announced since last month. So that's 411K barrels per day for June, same as the amount that they did for last month. And this is a big deal because previously OPEC said that they were going to release 2.2 million barrels of quota very slowly in small little slivers all the way to late 2026. But now with these two supersized increases, we're almost halfway there already. And so I think what this just means is that prices, as you've seen, have already reacted and are falling, and we're expecting things to keep going down, down, down.
Yeah, down, down, down. Nicholas, tell us a little bit more about the forecast right now, because we've heard from Morgan Stanley. I believe Goldman in the last few hours have also updated their forecast. What can you tell us so far?
Yeah, you're totally right. As you'd expect, the major investment banks which watch these prices closely have cut their forecasts. So Goldman Sachs has already cut it by $2 to $3. They're expecting Brent, the global oil benchmark, to be at around 60 for the rest of this year. Morgan Stanley also very bearish, has cut their oil forecast by something like $5 for the rest of the year. So they're expecting $60 for this quarter and $57.50 for Brent for the next 2 quarters onto the rest of the year. Now, it's worth flagging that Goldman said, this isn't just a decision that OPEC is taking on the backs of disciplining its people who are internally the countries that are cheating their quotas, like Kazakhstan. They've also flagged that this is a good way to strategically discipline U.S. shale producers who, as you probably can guess, are producing oil at a higher price than what Saudi can do. The other thing to flag is that Morgan Stanley is also expecting major output increases down the line, where previously I think most of us in the market were expecting smaller increases after the big supersized ones we've seen for May and June. Now it looks like people are expecting all of the taps to be opened all at once.
Yeah, a pretty rapid shift from OPEC Plus in their strategy there. It's all about market share versus really boosting oil prices. Our oil products reporter, Nicholas Lua, joining us there. Still ahead on the China Show, we're looking ahead to this week's Fed decision with Prestige Economics after that strong U.S. jobs report and pressure from President Trump for a rate cut. And a reminder that most markets are shut across the region, including here in Hong Kong. We'll have plenty more ahead. You're watching the China Show.
You're not going to remove, you don't have plans to remove him before 2026 when his time's up?
That was a total, why would I do that? I get to replace the person in another short period of time.
Yep, a slight dial back there from President Trump speaking about Fed Chair Jay Powell after his sustained criticism over the pace of interest rate cuts. You take a look at how Treasury futures are performing here this morning now that Japan is closed. We're seeing coming off some of the highs that we saw in terms of Treasury yields, right? Because after that jobs report came out, 2-year yields actually shot up in some ways. This was a much better than expected sort of print that we got out of that jobs report. So a lot of questions, Dave, on how resilient is this labor market in the face of a lot of global uncertainty around trade policy.
Yeah, there's a sense that this was the last good one before things start to soften. I think
how it could look.
How it could look moving forward, right? 12 basis points to the upside, to Yvonne's point, on the 2-year yield on Friday. Might be slightly lower going into the Monday session. Futures are certainly indicating that. U.S. futures, equity futures are down after, 9 straight days of gains in the cash markets. Again, we have a Fed decision this week. Just to keep in mind as well, Scott Bessent is actually scheduled to speak at a Milken conference on Monday, so keep an eye on that as well. Jason Schenker is with us right now, President and Chief Economist at Prestige Economics. Jason, good morning from the Asia Pacific, sir. Thank you for taking the time to speak with us. The soft data continues to be soft. The hard data continues to hold up. Which one do I pay attention to, Jason?
Morning, David. Yeah, it's great to be here with you. I think there's a lot of really confusing data if you're trying to take it all in at once. But I think as we're looking at the Fed and we're looking at markets, the top things to think about are the jobs numbers, inflation, and GDP. And if we look at the jobs numbers, that was pretty good. The labor market's been holding up. The JOLTS numbers showed a slowing of openings last week, but there's still almost 7.2 million open jobs in the month of March. Unemployment rates low in April at 4.2. We've got a record level of U.S. non-farm payrolls right now. We have a record high labor force. That's all really positive for the labor market. And even though jobless claims went up at a little over 1.9 million for continuing claims, it's only around 1.1% of the total labor force. So the labor market looks good. On the inflation side, we saw the PCE and PCE core slow, with the year-on-year PCE up now only 2.3%, the core up 2.6%. We're moving closer to the Fed's 2%. And as you discussed in the last segment, the drop in oil prices has been significant. We're seeing some more downside risk, and that could actually open the door then for the Fed to cut rates. As for GDP, if we look last week, we did see that drop in GDP by minus 0.3%. But there was a massive pull down because imports surged in Q1. There was a big pull forward effect. U.S. companies wanted to make sure they got their imports in before the tariff announcements on April 2nd, and that really pulled down GDP. Otherwise, it would have been a really strong print, which means in Q2, because they were pulling forward, you might see imports pull back. And if imports drop a lot in Q2, the net exports number could become a positive contributor to GDP, which means Q2 GDP could still be positive. Right now, based on the Atlanta Fed GDP now, it's reflecting 1.1%. 0.5% would be the positive print based on currently available data for Q2. So it's actually a pretty good set of dynamics right now, although there's a lot of data to think through.
Yeah, I'm just wondering with this jobs report, does it constrain the Fed, though, to cut rates sooner? We've already seen the likes of, I believe, Goldman, Barclays. They've already pushed back their predictions of how soon the Fed could cut. They're thinking from June to now July. Jason, what's your take?
There's been a big shift. If you looked at the CME Fed Watch tool a week ago, it looked more like a 2/3 probability of a rate cut in June. It now looks more like a 1/3 probability of a rate cut in June. I think what it does is it removes the necessity to cut rates because the job market's still pretty good, and almost 70% of GDP in the U.S. is consumption, people buying stuff, and people with jobs, they buy stuff, wages keep going up. All of that is supportive of growth. So if the labor market is still at full employment, the Fed doesn't see a giant red flag, warning sign, alarm to cut rates. As for the inflation side, we're still not at the Fed's 2% target, but we could see inflation ease over the next couple of months due not only to these lower oil prices, but some year-on-year base effects. And if inflation eases a bit further, that could open the door for that June rate cut. That's our forecast. We still expect a rate cut in June, but almost no probability of a rate cut in May this week.
Jason, how do I need to be thinking about the dollar? I mean, the dollar is effectively, and this is a relative term, I'll use the word collapse because we don't normally see the dollar fall this quickly against most, if not all, of their peers. And has that loosened now policy for the Fed? It might be sleeping on the possibility the Fed actually does not need to cut this year.
I think the dollar is really good for what the Trump administration is trying to get to, where they're shifting the U.S. economy towards a more industrialization, more manufacturing focused economy, moving more to a wartime economy to project more effective deterrence, to prevent a kinetic conflict with China over Taiwan. Weaker dollar really helps your exports, really hurts imports. That's a positive for GDP. It's positive for manufacturers. And even though the ISM manufacturing index contracted for a second consecutive month in April, it was still not too far away from the break even of 50. And some of the material handling data that we produce at Prestige Economics, the MHI-BAI, that index shows that we've seen continued positive expansions in new orders and shipments in the material handling industry, which is tied to supply chain and logistics. In other words, within the United States, there are indicators that the manufacturing and physical economy is doing quite well. And of course, a weaker dollar, very positive for that.
Jason, you mentioned something about how you think price pressures, oil prices could actually lead to inflation to start subsiding in some ways. I'm just wondering what impact would tariffs have in any way? Wouldn't that be inflationary?
Tariffs are a mixed bag because while tariffs can be inflationary, fear of tariffs can be recessionary or deflationary because it depends on what happens with the consumption dynamics. And of course, we've looked at the different categories where inflation might creep through, and there are a number of categories where it's likely to have an impact, but others that aren't. If we think about the categories that are most important for U.S. inflation indicators like shelter, it's not as critical. We think about food, well, that might not really be as significant because we're seeing China reducing some of its imports of food from the United States. And that means there may be other food products that are more available. It'll depend on the mix of products. There is a risk of more inflation later in the year. But again, that depends on what tariffs stay and what tariffs go. So it's really going to be something that is one of the uncertainty things many companies are trying to think through in the year ahead.
Jason, your wild card. What's a known unknown that could mess with your math, sir?
Biggest known unknown is that we move from the Cold War II environment that we're in right now, where the United States and China are at loggerheads, and you see those tensions accelerate, and that could be a bigger risk, where if suddenly China decides to move up the timeline for a permanent blockade of Taiwan, that becomes a material risk. We've seen those drills around Taiwan multiple times last year. We've seen different drills this year. If we see that kind of thing accelerate, if we see actual move towards kinetic conflict, that's probably the absolute biggest wild card. We go from Cold War II into a more hot war scenario.
And Jason, I got to ask you, too, just where markets are right now. I mean, you look at the equity market, you look at the treasury market, it seems like nothing has happened since April. But then I look at the dollar. I look at oil prices, for example, which has been more than 15, 16% down for Brent. What are these dislocations telling you right now, especially when it comes to oil prices, too?
Well, this stuff looks really good if you want to reindustrialize the U.S. economy, because you now have, with lower oil prices, probably lower inflation, greater ability to cut interest rates, and a weaker dollar, which favors exports and is going to hurt imports. If I was trying to reindustrialize the U.S. economy and move it to a more wartime footing and increase manufacturing, I would want a much weaker dollar and lower interest rates. Lower oil prices help get you there, and a lowering greenback certainly helps along the way.
Right. What's your forecast on oil?
Oil prices for the balance of the year, even before today's announcement, we were expecting prices to average between $61 and $61.50 for the balance of the year. And for next year, we see it closer to $65 a barrel for the average.
Jason, always good in terms of tying it all together for us. Jason Schenker, President and Chief Economist at Prestige Economics. We got plenty more ahead. This is Bloomberg. All right, some events we're watching out for this week. It could be a pretty busy one, especially now that we have this jobs report, the Fed rate decision, where the Fed is going to meet on Tuesday and Wednesday as well. How is Powell going to play out this narrative of a resilient labor market with the likes of the risk of the global uncertainty around tariffs? That's going to be a key thing as well. The BOE decision, that's definitely worth focusing on, because I think it's almost certain that they might cut this meeting. But the big question is whether members will actually call for a 50 basis point cut as well. And we wrap up the week with that April trade data out of China. And after that China PMI number, where those export orders, new export orders came through, it'll be really interesting to see what these numbers show on Friday. Yeah, it's the first full month actually after the tariff Liberation Day announcement. So you have a full month that, arguably, it's the first full month that, we're really coming off the front loading. So I think that's a key thing to keep in mind there as well, going into the trade norms coming through. But again, we're still, as far as the data goes, fairly noisy, because, we still don't know how these things are going to land. In fact, when you look at what's been happening in the FX markets, it's really been about one story. Dollar has been down. Equity markets, a lot of markets are shut in the Asia Pacific. You are getting Taiwan coming online. And speaking of Taiwan here, the Taiwan dollar is off. Dollar Taiwan, 2.6% to the downside. So we now have a 2 handle on this. That should be the first time in years we've had a 29 handle on that. The biggest two-day drop in the dollar. U.S. dollar against the Taiwan dollar on record. And we are still on intervention watch. We are on holiday today, but that doesn't mean the HKMA is not watching currency markets. 70.75. We're very, very close to that as we speak. Plenty more ahead. You're watching The China Show. Good morning.
Trade is not a zero-sum game. Building barriers only blocks the flow of shared growth. The tariff war was not launched by China. We don't want to fight. Neither are we intimidated. We are defending not only our own legitimate rights and interests, but the order of international trade.
Chinese ambassador to the U.S., Yvonne, they're speaking at an event in D.C. and interesting how he continued to kind of hold firm on where China lies when it comes to coming to the table to talk with the U.S. But also over the weekend, we did see that they were evaluating the potential of actually talking with the U.S.
Yeah, and markets responded really quite favorably when you look at how we closed out the week.
Yeah.
Risk assets were generally bid. I think the curious thing, though, is why the dollar keeps falling, which is also interesting. But yeah, it is good news. But I think several comments coming through out of the U.S. president early this morning. One is, well, tariffs he think will be brought down at some point, according to him, on China tariffs. Number two is he's planning 100% tariffs on foreign-made films, in case you missed that point. And also, along the lines Yvonne was just alluding to there, no plans, at least the way he's phrased it, that he is not going to speak with the Chinese president this week. Not that we were expecting that anyway. But all that being said, the big story as well is, given the backdrop of just a weaker global economy, it's become a battle for market share as far as OPEC Plus goes, right? So 3.7% drop in global prices moving forward. Let's please look at where you are on A50 futures. So we are on a holiday today here in Hong Kong and up in mainland China. A50 futures are doing this. The big story, again, in the currency markets, we keep going back to this, right? We now are below the 7.2 handle on dollar China, and we're now extremely close again to 7.75, which is really the strong end of the trading band here in Hong Kong. In fact, when you look at over 3 days, boom, all the way down from just closer to 7.30 to now below the 7.20 handle. In fact, we're now pushing the 7.19 here on dollar China. So it's been an extremely large dislocation across the dollar, across many pairs.
There's a great story on the Bloomberg that talks about this dollar decline and how it's really fueling these dislocations across Asia. FX. We talked about the interventions that we've seen in this part of the world, but even speculators they're talking about the most bearish on the dollar anytime since September. So there is this growing reluctance among investors to really hold on to dollar as assets in general. How long can this last? That certainly is a big question. We've got to ask to Joey Chu, head of Asia FX research at HSBC. Joey, it's great to have you on the program. And Joey, it's interesting, right? We talked about that strong jobs report. We talked about these trade tensions seemingly looking a little bit softening now, and yet the dollar continues to head lower. What do you make of it right now?
Well, I think a lot of people are thinking that, we've moved on from the tariff escalation phase to the de-escalation phase and likely the negotiation phase as well. And during this time frame, we still have suspension of tariffs or maybe even no tariffs on certain exports like semiconductors. So we could be in a situation whereby FX supply from exporters are still high because the trade surplus are still large, but FX demand could be a little bit lower, be it from importers or from central banks, because of this uncertainty about what's going on with the dollar. So I think this dislocation is coming up because of this imbalance between this FX demand and supply.
So, Joey, I'm curious what the appetite is among, at least with the HSBC clients that you speak to, appetite to hold dollars right now. How would you describe that?
I would say that there's a lot of questions about, number one, what the U.S. wants, because, we do hear a lot about, comments about Mar-a-Lago Accord, etc. But at the same time, we do understand that, or at least people do understand that, Asian exporters are under a lot of economic pressure, and the theoretical outcome of this kind of economic pressure used to be depreciation against the dollar. So there's a lot of confusion about, theory versus reality, or theory versus what the U.S. administration could possibly want. So there are a lot of questions right now, and I think we're doing times of questions and uncertainty. It could just be that people just try to do the conservative thing, which is to FX hedge.
Okay, and so where to next on this kind of de-dollarization theme as well? You're saying that this could actually support different Asian currencies in different channels. Can you flesh that out a little bit?
Yeah, sure. So as mentioned, FX hedging for Asia tend to mean selling dollar, because Asia, at least a lot of Asia are net exporters, so they hold on to a lot of dollars. When it comes to FX hedging, it means selling their dollar proceeds. So there is that channel, and I think we saw that very clearly in dollar Taiwan, right? And it's not just exporters. We also know that over the years, a lot of life insurance companies or other institutional investors have invested a lot in the U.S. assets. So that requires some FX hedging as well. So the first order is always FX hedging before we can talk about asset reallocation, because asset reallocation tends to be a big decision that takes a while to get through. So I think really what we are seeing in recent weeks is actually FX hedging flows rather than asset reallocation flows. But that could be the next thing in going forward to monitor, right? And so far the data has not actually showed that much signs of it. For example, the Fed publishes a weekly data on what official accounts have on U.S. long-term assets, and actually that shows very little change in their holdings of U.S. treasuries.
Right. So what's next then? Let's look at the Taiwan dollar specifically, because it has a lot of, to your point, a lot of different strands to it. There's the life insurance business. There's what they need to do to hedge that risk, for example, as you have this fairly sharp dislocation in dollar Taiwan. Where do you think the exchange rate goes next? And is it getting to a point where it's counterproductive, really, for some?
Yeah, I think it's the move has gotten too fast. So I think those who actually have not FX hedged might not necessarily want to FX hedge at this point, right? Because hedging costs are really very, very high. It's come to the point whereby you need to ask yourself, is paying 7% FX hedging cost worth it? Or is Taiwan dollar really going to move another 7%? So for some, it might actually be a wait and see moment if they haven't gotten in yet. So they might want to wait for a bounce in the dollar before they can think about their next steps. So the next steps, I think, for dollar Asia in general is really just wait and see the data to see whether there is any bounce or whether there is any disappointment when it comes to US-Asia trade talks, because some of the optimism really is about the trade talks. But as we know, these things are very unpredictable and there could always be disappointments.
And what does this mean for central banks as well? I mean, given that the currencies in Asia are doing well now, Joey, does that give them more room to cut rates? We saw the Bank of Thailand did have a rate cut recently too.
Yeah, I think for sure, a lot of Asian central banks, even before the trade war, was already leaning towards rate cuts, right? Like we saw a couple of rate cuts already last year from Bank of Korea, even in January, Bank Indonesia. So there were already this bias towards relaxing monetary conditions. So now that currencies have appreciated, for some in Asia, that actually constitutes as a tightening of conditions. So there's even more urgency in some sense to also relax conditions via rate cuts. So I will not be surprised to see, more central banks actually feeling more confident about the need to cut.
Joe, I need to ask you about the renminbi. I mean, certainly there's a massive rate differential between onshore and what's taking place offshore. Right? Dollar funding costs remain substantially high. You look at yuan funding costs onshore, substantially low. How does that affect, you think, the spread between onshore and offshore yuan? And how do I need to be thinking about now how that goes moving forward?
Yeah, I mean, right now, obviously, there's this huge dislocation because onshore has been on holiday, right, and will only come back tomorrow. Then the other thing is also that, offshore tends to be a little bit more driven by non-exporters, whereas onshore a bit more driven by, importers and exporters. And I think it's fair to say that Chinese corporates will probably be a bit more hesitant to do large FX transactions at this point because US-China tensions, even if slightly, thawing out, is still very, very difficult. So some of the offshore optimism may not necessarily translate to onshore. So I think there's going to be still some gap between onshore and offshore. But of course, when tomorrow comes back, I think it makes some sense for the two to try and converge a little bit. So onshore might actually try to, gap down to converge to dollar offshore. But still, I would say that the optimism levels are definitely going to be different, not to mention the funding cost level, as you already mentioned, that would also be different. So this will still provide a little bit of a wedge between these two things.
Yeah, can you talk a little bit more about the need to keep the currency stable in the face of maybe potential trade talks? Is the currency being used as a potential kind of, I guess, tool in these negotiations too, Joey?
Actually, in terms of this, trade talks with different Asian partners, I think only Korea has sort of confirmed that exchange rate is one of the July package of topics in their talks. As for India, as for other countries, it's a little less explicit. Taiwan, however, did mention that the US has not asked for a stronger Taiwan dollar. So I guess implicitly it also suggests that there has been discussions around the exchange rates as well. But regardless, I think what's going to happen here is that a lot of people are just going to think that during this juncture, it's probably going to be difficult to see much dollar support coming from the official channel when there are negotiations.
Joey, thank you so much, and have a great week ahead. Hi to the team for us, head of Asia FX research there at HSBC. Over in Singapore, talking about the dollar and the softness there. In fact, we'll just head to the break. We'll come back on the other side of it. We'll leave you to look at the dollar falling out of bed this Monday morning here in the Asia Pacific. Good Monday morning, by the way.
Now, as President Trump roils global trade, voters are leaning towards stability, delivering strong mandates to incumbent governments in Australia and Singapore over the weekend. Let's get to our reporters Swati Pandey and Avril Hong. They're standing by with more. Now, Swati, let's start with what we saw in Australia and this historic win for Anthony Albanese's Labour government.
Yes, it was quite a surprising victory. The polls were suggesting that Anthony Albanese will win, but nobody had predicted this margin. It was a landslide, and the election was called pretty early on in the counting stage as well on Saturday night. It gives Albanese a very strong mandate to go ahead with his campaign policies, to probably do some economic reforms as well that are much needed in our economy, and maybe have a greater bargaining chip with Donald Trump as well.
Right. So lay out if they're able to now do that with that stronger mandate, because some of these outstanding economic issues have been outstanding for some time now, Swati.
Yes, it is pretty politically difficult in Australia to do any major tax reform. The last time Labour government tried it, there was a huge campaign against it. It lost it lost its power, and the Liberals took over. And since then, this was in 2012, and since then, no other government has really tried to touch mining tax or other kind of tax reforms. It's just been seen as politically really difficult. However, Australia has been in a per capita recession for 7 consecutive quarters until pretty much late 2024. And things have not really turned around, and doesn't look like things are changing for the better. And the only thing economists say will improve the economy is if we do tax reforms and some productivity enhancing measures. Right now, the conditions do look ripe for those to happen.
All right. Swati, thank you. Swati Pandey there, our Bloomberg economy reporter, on the latest on the Australian elections. And we now switch to Singapore now, where the Prime Minister Lawrence Wong has secured a strong mandate himself in his first electoral test, with voters choosing stability amid the turmoil of the Trump trade war. Let's bring in Avril Hong. She's in Singapore for us. And Avril, there's a lot of questions about what we're seeing in Australia, what we're seeing in Singapore as well, of the Trump effect on these election outcomes. Tell us more on how these global uncertainties have really influenced voters this time.
Yeah, Yvonne, I mean, if you look at the vote share, you look at the number of seats that opposition secure this time around, I think this resounding victory for the ruling People's Action Party that has, of course, governed for more than 60 years just tells you more about what voters are seeking in these times of global uncertainties. They want stability, they want a safe pair of hands, and that is what the election results have really been telling us. And amid all this, you cite Australia, but also, don't forget, Canada, right? So it's really this idea that in a time of shifting geopolitical alliances, one of these analysts have been pointing out voters in Singapore were never going to take a gamble in the form of a protest vote. So that kind of neutralized the inflation concerns. And it's also worth noting that domestically, the Prime Minister, after taking over in the past year, has been coming through with a more consultative approach, engaging younger voters more, and also deepening social aid. So what we've also been seeing in Singapore is announcements of jobless benefits. This is a key shift for the country. So all in, these external as well as domestic factors that have kind of prompted the public to showing more confidence in the ruling party.
Right. So what's next then in terms of, well, 2 things, Avril. One, domestically, certainly the cost of living is a big issue. What should we be paying attention to there in terms of foreign policy and trade? What's next as far as that's concerned?
Yeah, so domestically, after the results, the Prime Minister already said they will redouble these efforts to mitigate the cost of living crisis. So it sounds like they will bolster support as well, not just because of the high cost of living, but when it comes to retirement, to housing as well. So really here, a deepening of social aid. That's something that we've seen the Prime Minister, that tone, take in terms of his leadership. But externally, when it comes to foreign policy as well as trade, it's worth noting that in one of the key battleground districts, which fielded the Deputy Prime Minister, Gan Kim Yong, who is in Singapore known as the Task Force Man, he was fielded in a district which showed this really strong challenge from the opposition, yet he managed to stave that off. So going forward, when it comes to trade negotiations, which of course he is kind of leading the way as far as the task force for Singapore's response to the tariffs are concerned, you do get the sense that Singapore's leadership is going into any negotiations or response to the tariffs with greater confidence.
Avril, thank you so much. Avril Hong in Singapore for us, and the latest there out of Singapore, and certainly the global relevance of all these elections that come out, not just on the weekend, right? In fact, you just take a step back even further when you look at what took place in Canada last week. In fact, we'll unpack that even further for you guys as well. In the next hour, we have CSIS, of course. This is separate, but it's certainly part of the geopolitical conversation here. The rare earth card that China does have, of course, and also as it pertains to the Singapore elections, the global relevance of what took place on the weekend. It really underscores this trend that's re-emerged because of the lack of predictability that we've seen so far.
Yeah, they
the
just
White
want
House.
something stable at home. But the key question is, now that they have gotten these strong mandates, as Avril mentioned, what are they going to do about it, right? How far are they going to go to stand up against Trump when it comes to tariffs as well and other threats out there? And for the conservatives and the opposition as well, it's certainly a lesson learned about how much can they align and embrace Trump moving forward.
Yeah, they've certainly lost ground as far as parties that were, slightly right of center.
Yes.
And I think that was really the momentum going into that was good until the things became counterproductive as far as that was concerned. And then the sort of reset that we've had so far. Right. Plenty more here on the shows. We'll talk more about the oil story, the massive drop we're seeing in oil prices, the equity complex, and also this massive collapse. And then we'll talk more about this in the U.S. dollar against the Taiwan dollar, historic drop we're seeing today. Plenty more ahead.
Welcome back. Here are some of the big stories we're following around the world. President Trump says he's planning to impose a 100% tariff on movies produced overseas. The move will extend his restrictive trade policies on U.S. imports to the entertainment sector for the first time. It remains unclear how such duties would work or how such works would be valued for tariff collection purposes. Many films from Hollywood studios involve global production. Bloomberg has learned that representatives for Indian billionaire Gautam Adani met Trump administration officials about dismissing the criminal charges against him in relation to a bribery case. Sources say that talks, which began earlier this year, intensified in recent weeks and could lead to a resolution in the coming month or so. Adani's camp are trying to make the case that his prosecution doesn't align with President Trump's priorities and should be reconsidered.
Right. So the big event, of course, in the weekend, well, among the many others, was the annual meeting, of course, at Berkshire, and the big guy dropping the gauntlet here, giving us really a lot of news to talk about. First, obviously, is the cash hoard, and the other announcement, of course, that Warren Buffett was stepping down as CEO. With tech and bank leaders, they're rushing to praise the legendary investor for his inspiring lessons on life and business. In fact, Karen Lee is with us right now, our global business editor. Just talk us through the significance of this announcement and the latest here for its leadership here, Karen.
I mean, you guys know as well as I do how big this is. And Buffett apparently waited till the final minute of his 60th shareholder meeting to drop this long-awaited announcement. He said it would be the last as the head of the $1.2 trillion Berkshire Hathaway. And now this was a surprise, not just for investors, but for a lot of his board and for his successor, Greg Abel. And there's a lot at stake for Abel now. Of course, he's an energy executive. He's long been rumored to be in waiting. And some of the biggest questions are around what he's going to do with Berkshire's record $350 billion million pile of cash. Shareholders, of course, also have other questions in these early days about how he's going to run things at a company that's been so closely associated with the strategy and the personality of its founder. Is he going to change a lean C-suite? Is he going to bring a different risk tolerance? Is Berkshire still going to be a first port of call for companies that are looking for a big check and a vote of confidence? And they're even wondering now about the future of the annual general shareholder meeting, or the annual meeting itself, which has gotten this reputation as a kind of Woodstock for capitalists. So a lot of questions swirling in these early few days.
Yeah, are they going to still have that sort of celebrity, the wit of Warren Buffett at these meetings? That's certainly one thing, Karen. But tell us a bit about the numbers. There's a big one in the headline, right, of 5,500,000% run on the stock.
Yeah, I had to read that a few times too. And let me just read you a couple of the numbers that we put across the terminal just to give you an idea of some of the figures for this company. They're startling even by our standards. He delivered that 5,500,000 return on Berkshire stock. Berkshire has 180 operating businesses, annual revenue of almost $400 billion, a stock portfolio of over $260 billion. And, you know, Buffett's really been synonymous with these investing themes like being greedy while others are fearful, for his stock picking prowess. So there's going to be a lot of focus, probably more than you would normally see during a regular leadership transition, on Abel's early moves and specifically how he handles that record pile of cash.
Karen, thank you so much. Karen Lee there on, the big breaking news there. He waited to the last couple of minutes to
burying the lead,
to go for the win, as they say. Buzzer beater there. Very brief look at markets right now. We're looking at oil counters across the Asia-Pacific. Of the very few markets that are open, and as you can see, this decline across the Aussie space as Brent prices drop 3.5%. It's not just Brent. Dollars also offered up quite substantially this Monday. Plenty more ahead. We'll unpack really the dollar story in a moment for you. You're watching The China Show. Right, welcome back. You're watching The China Show. Quite a wacky day in currency markets right now. Perhaps one would be because we had a wacky Friday, and that's certainly exacerbating some of the moves. We're focusing on the Taiwan dollar right now for a really good reason. You're looking at the Taiwan dollar up against virtually everything and up substantially against everything. So everything is down against the Taiwan dollar. I think that's point number one. Point number two is we're coming off, and we have a chart that shows you this, we're coming off a very steep gain on Friday. And it's getting exacerbated right now. Is it hedging? Are they pushing hedging costs even more expensive? Is it still worth hedging at this point, at 29, and given how far hedging costs are, right? So just to give you a sense of the magnitude of the drop in dollar Taiwan, it's now the biggest two-day drop on record. So we've gone from about 33.5 to now 29 on the exchange rate. That's taken a measure of momentum now to below 10, right? Below 30 is already extreme. Below 10 takes you back about 17, 18 years back. So that's really just an indication of this collapse in momentum in the U.S. dollar. Now, it's indicative really of not just a Taiwan dollar story. When you look at what's taking place across not just the Taiwan dollar, you have the Chinese currency, you have other Asian currencies, you have the South Korean won, for example. Dollar China is now trading with a 719 handle, Yvonne. So it really begs the question, is it what's happening? Yeah. What's happening with the U.S. dollar?
Let's bring that question to our MLI strategist, Mark Cranfield. He joins us live from Singapore. And Mark, you've been writing about this on the MLI blog all morning. What do you think is driving these massive moves in dollar Taiwan here at the moment? Some are saying it's hedging activities. What do you see?
Yes, definitely will be some of that, and there'll be some is reversal of speculative moves as well, and a whole number of things. Corporates hedging, a whole factor of plays there, and it's really the second stage of the dollar down move. So phase one was when the dollar started losing ground against major currencies. That was a few weeks ago. We saw the euro, the yen, and the Swiss franc especially. Now, even though people are thinking that the trade war maybe is thawing a bit, most of those currencies have held their gains against the US dollar. Phase two is the rest of the world getting involved, especially Asia. That really seems, the balance of that seems to have tipped from last week, when people became optimistic that China was reaching out to the United States more than it had been before. Now, one of the currencies which undoubtedly speculators are really been using a lot as a hedging tool against the risk of a very long trade war was the Taiwanese dollar. One of the reasons you can do that is because through the forward curve, you actually get paid to short the Taiwanese dollar. What that means is that you can go short of the currency without incurring any great costs, as long as the foreign exchange market behaves itself. The minute things turn, as long as sentiment turns quickly in favour of a currency, then it unwinds what's happening in the forward market. And that's exactly what we've seen in the past couple of days. People are now scrambling because a trade that looked relatively easy to be short of Taiwan is no longer such a clear-cut trade. On top of that, you have very, very large Taiwanese companies who probably haven't hedged their dollar inflows as well as they should have done. You've also got insurance companies who are notoriously underweight of the US dollar. They buy or underweight of the hedges. They buy US treasuries. They do not hedge back into the Taiwanese dollar until they think that they're really threatened. Well, certainly now they'll be pretty worried about the moves in the currency. Now, this spreads across to the rest of Asia as well, because the Korean won will be closely attached to what happens with the Korean currency, the Taiwanese currency. Then you've got China, which is closed at the moment. So the offshore yuan has more freedom to move until China comes back from its holidays. We could see the offshore yuan move 10 big figures inside where the onshore last traded because there's no PBOC around to stop the moves. It's all getting a little bit dramatic. And to add to the friction today, London is closed for a holiday. London is one of the biggest trading centres for offshore Asian currencies. It means that by the end of Asian trading today, where both China and Hong Kong and Japan are all closed as well, we get to London, liquidity will be reduced as well. The chances of chaos today are pretty high.
Yeah, well, I was going to get to that, Mark, and I'm wondering in what form do you think that, what are the first signs that this is spreading beyond the Taiwan dollar? And I also want to ask you about you mentioned something on the forward curve, right? And one of the things I thought of when you mentioned that was one of the common denominators between at least the Taiwan dollar and the Chinese currency is you have cheap funding costs, right? These were funding currencies, and I wonder whether we could see the same. That's a question mark when it comes to the offshore Chinese currency, because that would be a bigger problem if that came to fruition.
I think we started to see that happen even before the Taiwanese dollar. We saw that the people were becoming a little bit less concerned about China using the yuan as a big mechanism to fight the United States in the trade deals. The PBOC have been keeping the daily fixings very steady, even though the rhetoric from the US was getting pretty hot. China was pushing back pretty hard, at least on an official level. And yet the central bank in China was keeping the daily movements of the yuan pretty steady. So foreign exchanges, traders can see that. They can see that things are changing, that they don't need to be so much against the currency in China. They can be a little bit more neutral. Once that starts to happen, then the flows of money also coming back into the Chinese stock market as well, particularly via the Hong Kong leg as well. So money is naturally starting to flow back into the yuan. The hedging situation was not as easy as it was a year ago. If you want to short the yuan, it's not as compelling as the case was, say, 9-12 months ago. All of those things were starting to mean that the yuan was becoming a slightly stronger currency anyway, even before the Taiwan dollar started to move. Now we're thinking that with the PBOC keeping the fixing quite a bit lower than where the market was already pricing, that means that there's a natural space for the currency to move into, even with the PBOC doing nothing. If the PBO decides it can be more relaxed because it thinks there's a chance of a trade deal coming, then we could see dollar yuan drop a lot further, because then the PBOC will actually be encouraging people to start to move their money back into the yuan. They were dissuading them earlier in the year. They've moved into a more neutral situation. If they actually turn into a positive stance where they want people to move the money back into yuan, it can go a very long way.
Yeah, Mark, I mean, it's getting to a point where we're even talking about, say, the Hong Kong dollar, right? The Hong Kong dollar doesn't make the news. It's almost like breathing. It's not supposed to be noticed. But here we are. The HKMA is also intervening. It's being forced to intervene. We've heard from, as you mentioned, the trade deal, and we're hearing from trading partners of the U.S. and where these negotiations are taking place. Like the Japanese is a good example. You know, the currency is not part of the trade deal. But I'm wondering, though, are currency markets starting to front run, you know, some version, future version of a potential Mar-a-Lago Accord where the dollar will remain depressed?
Certainly there's some talk in the market that people fear there could be an agreement on currencies coming at some stage. But I think you also have to look at the overall damage which has been done to the credibility of US institutions. And that, from a macro trader's point of view, if you're uncertain about what a country is doing in terms of its trade balances, in terms of what it's doing with its fixed income markets, the way it funds itself, all of those things are reflective in the currency. And macro traders, the easiest thing for them to do when they don't like what they see is to short the currency. And that is part of what's happening with the US dollar. So that theme probably has quite a way to run because people are pricing in a discount for anything related to the United States. We could easily get back into a situation where US equities recover, people are more optimistic on what's happening in the US stock market, but they still don't like the US dollar. We've seen that before. The currency and the stock market can go in different directions. The US still has a lot of funding to do in the Treasury market, a huge amount of funding. And people are pretty unsure about at what level they'll be able to do that. That's another negative for the US dollar. So there are a whole number of factors which are weighing against the currency. They're not going to go away easily. And then, of course, you've got the possibility that the next move from the Federal Reserve will be to lower interest rates. Whenever the Federal Reserve is cutting rates, that's never a good thing for the currency.
No, and especially a rate cut that we don't see coming too. Mark, thank you so much. Fantastic context there from Mark Cranfield out of our MLive team. You don't need equity markets to be open to really have a big market story today. All that being said, we are looking at a lot of market closures today, given, of course, holidays across the region. Yvonne did pick a really good time, or maybe an inopportune time to come back to
I thought it was
work.
going to be quiet, and then all this FX volatility is going on, and I'm like, oh, what's happening?
Thank God you're here, though.
Okay, let's hold our hands together.
Yeah.
All right, we'll go get through this. Coming up, we're going to be drilling down into the global supply of rare earth minerals as the U.S. seeks other sources in a market dominated by China. That is next in our deep dive segment. This is Bloomberg. All right, we're continuing to track this trade war, and one thing in particular, tensions continue to simmer between the U.S. and China. Let's talk about rare earths. Now, they are becoming a point of contention between both countries, the U.S. and China. Beijing last month added 7 critical minerals to its export control list in response to U.S. duties. Now, the targeted minerals are crucial to various products and spanning nuclear equipment, fighter jets, and even smartphones. China dominates both the mining and refining capacity for rare earths. Joining us now to talk a bit more about this is Gracelin Baskaran, Critical Minerals Security Program Director at the CSIS in Washington. Gracelin, it's great to talk to you. We talk about how China basically is near monopolizing this market. How powerful of a negotiating tool is it?
A pretty significant negotiation tool, and here's why. Even though we produce rare earths, heavy rare earths here in the United States, we actually don't have any separation capabilities built. We're currently building them. The U.S. government has spent over $400 million in federal subsidies to build these facilities in Texas and in California. However, they are still under construction. So we saw already that President Trump has indicated a willingness to negotiate, but that's really because we're at a chokehold now.
Okay, so let's put this into context. I wonder if you can do this for us, right? So what the U.S. needs to do then to increase its security as far as this is concerned. And, we know what China's trying to do as far as semiconductor goes. That seems to be a multi-year process. What does the U.S. need to do to increase its security as far as this is concerned?
Yeah, so it's a two-piece puzzle that we need to follow. And it's the same thing that China has been doing for decades. Remember that China has been strategically building its rare earth chokehold over the course of decades by first sourcing rare earths from around the world. China doesn't actually have all of the rare earths. What they have strategically done is mine what they have at home, but also source rare earths from around the world. And then the second thing they've done through targeted domestic industrial strategy is to bring those rare earths back home and to be able to process them. They have created a dominance over what we call the mine to magnet supply chain. Those permanent magnets are critical for everything from the defense industry, submarines, warships, fighter jets, missiles, tanks, all the way through to the automotive industry. We've seen the automotive industry particularly hard hit by the dysprosium restriction through other forms of manufacturing like MRIs and PET scanners. So we have to think about the mine to market supply chain, because wherever there's a gap in that supply chain, China already has a stronghold on it.
I like that, mine to mag. I'm just wondering, though, what would it take, though, for China to actually lose a bit of that grip on setting prices, for example? I mean, could an Australia, for example, or Ukraine be an alternative supplier in any way?
So Australia has good reserves of rare earths. The U.S. is actually the second biggest producer of rare earths. The difficulty that we have is we do, until recently, until these restrictions, we did send them to China for separation and then bought them back. Malaysia has also been a key player in this. Vietnam and Brazil actually have the second and third biggest reserves of rare earths in the world after China. So these are all countries that we can get rare earths from, but the difficulty is that separation phase. And there's a few challenges we have. One is they're expensive. It's a lot of capital. And the private sector, because of the price dynamic that you mentioned, hasn't shown a clear interest in wanting to go into that. So we've used federal awards. The second difficulty is actually the technical know-how. In December 2023, China actually banned the export of rare earth processing technologies. And the world kind of woke up and also realized we didn't know how to do everything. Kind of took it for granted that China did it. So we've had to start to build technical know-how in some of these key areas. So we're kind of learning as we're going in some areas. So it's both capital in a place where prices are low, but also the technical know-how.
What further runway do you think that the Chinese have in as far as further restrictions are concerned, given the current settings that we have now already?
Great question. I mean, China's been rolling out for 2 years a ramp up of export restrictions. It started with the gallium and germanium in 2023, which are both critical for semiconductors. And then it moved on to antimony, which is a number of defense technologies, as well as hardens the chassis in our cars. We've seen export restrictions on graphite, tungsten, rare earths. We expect to see that list get longer, is the reality. China actually has a pretty dominant share of over 20 critical minerals in terms of production and processing capabilities. So we're definitely not to the end of the list. So that's number one. The second thing we have to remember with rare earths is this is not a ban, right? So if you think about a runway of export policies, this is what we call non-automatic licensing. So companies have to apply to get a license to export them. But things can be tightened a lot, all the way out to an outright ban, which is what we have for antimony, gallium, germanium, etc. So China can tighten this to an all-out ban and could potentially also extend them to light rare earths. Now, light rare earths wouldn't be as impactful because we do have some separation capabilities for those here in the U.S. and in other countries.
And that would put the U.S. in a pretty vulnerable position, I assume, Gracelin. What does this mean in terms of their capabilities in defense and security and even innovation?
Hugely impactful for manufacturing. I mean, we tend to think about rare earths limited through the defense sector. But like I said, automotive manufacturers have been hit front and center by many of these export restrictions. So those are American companies like Ford and GM. But also, I mean, some of these rare earths that are banned are also used in cancer treatment. So it's our medical supply chains. And that's the challenge, right? These are dual use goods for military and civilian, and they undermine our ability to actually manufacture the end use.
And Gracelin, final question for you. In what form has this already impacted everyday business in your view? What's going on there in the U.S. now?
I mean, first and foremost, we've seen just a surge in prices. I have a friend who's a rare earth trader, and in the days after the restrictions were announced, he couldn't draw down from an Asian stockpile at 20x the price. And that really is a reflection of a couple of things. So first, as mentioned, this isn't a ban, but there is going to be an export licensing process, and that can take 30 to 60 days to develop, which means in that time, things are not being exported, number one. Two, the other consideration is at the same time that China announced these export controls, they also put 16 American companies on an export restriction list, and 15 of those are defense and aerospace companies who can no longer access dual-use materials. So for those companies, this is particularly crippling because even when licensing resumes, it's likely they won't be able to access these materials. So what we're seeing is that there's already that surge in price, which of course undermines not only access, but the cost competitiveness, right? Keep in mind that our auto manufacturers are struggling under the weight of policies ranging from slow electric vehicle uptake to tariffs. So now putting in supply chain vulnerabilities really adversely impacts them.
Gracelin, learn something new every day, certainly on my part. Wow, thank you so much for that briefing there, really, in some ways. Gracelin Baskaran, their Critical Mineral Security Program Director at the CSIS. Right, and subscribers, by the way, can watch us live here and also scroll back. And yeah, it's been about an hour and 20 minutes into Yvonne's first day back. So tell us what you think about how she's done so far.
Gosh.
All right, you can do a deep dive into any securities. And by the way, so you can send us more questions for our guests coming through as well. We'll be talking about a lot of things. We have the Singapore elections and a debrief there coming through. Plus, we'll be talking about this proposed 100% tariff from the U.S. president on all foreign films. What that means, well, we'll try and unpack that for you as well coming through in the next few minutes here at the China Show. Right, welcome back. Now, Donald Trump's economic advisor, Stephen Miran, is not ruling out the volatility in future U.S. data amid this ongoing trade tensions. But, he told Bloomberg, he spoke to our colleagues, of course, at Surveillance, that metrics that came out after President Trump's tariff announcement still remain sound. That's the context.
There's been an ongoing disconnect between the hard data and the soft data, and the hard data continued to perform very well. 177,000 jobs last month, a beat of 40,000 jobs. That's the president's second jobs day beat in a row. And on top of that, you've got 11,000 construction jobs, expanding construction sector in spite of the president's crackdown on the border, disproving critics again. And the hard data continue to be okay. And I think it's worth emphasizing that these data represent the period after the president's historic actions with tariffs on April 2nd.
So, Stephen, we need to get into that because there are some people that we've spoken to that worry about the next report. They think that this could show up in the May report. And I've heard the words downside risk repeatedly. Are you confident that some of that's avoidable?
So, look, given the historic scope and speed with which the president acted to put American workers and firms first for the first time in decades, it shouldn't be surprising if there's some accompanying volatility, and that extends to financial markets that we've seen, and it could extend to economic data also as companies sort of substitute activity from one month to another. That remains to be seen. But so far in the hard data, we're not seeing any real evidence of that to be the case. And as you pointed out, there are various soft data sentiment indices that look not as good, but those tend to be influenced by financial markets. And there's been enormous volatility there lately, as you guys are aware. And they tend to be influenced a lot by politics. But historically, the correlation between those and activity has been weaker in the last few years than it would have been, say, 10 years ago.
We are seeing it show up in some hard data, and that's trade volumes. We just caught up with the Port of LA director, Gene Soroka. Stephen, I wonder if you've been in touch with them and how you see this playing out. They're telling us now that trade volumes are about to fall, that what they're about to see through their port could drop by something like a third, 30%, and then from there this could ripple through the US economy. What's the sequencing of things from your standpoint?
Thanks. So as I mentioned a moment ago, there can be some volatility in the economic data, and I think it's worth emphasizing that there are some firms that want to see the outcome of trade negotiations, which will be coming soon, and they want to see the tax bill passed, which again will be coming soon. And as a result, they may substitute activity from one month to another, from one quarter to another, but it all gets averaged out over time. These are not the types of activities for which activity would get canceled permanently. And as you mentioned at the start, the GDP report contained a 5-point drag from import activity. So we're just coming off of a quarter with an enormous amount of imports that by the way, there was a data anomaly in the GDP data that I'm sure most of your audience is aware of by now. But after such a huge import drag on the economy in the first quarter, it wouldn't be surprising if there were a little bit less imports subsequently. I mean, but this stuff all averages out over time.
And that was the U.S. Council of Economic Advisors Chairman Stephen Miran speaking to Bloomberg there. And a check of markets here, it's really all about Taiwan this morning.
It's crazy. It's great. I mean, who would imagine this? This is a generational move we're seeing right now. It's hard to underscore the magnitude of this move we're seeing right now. So a lot of the Treasury ETFs listed in Taiwan are sort of taking the collateral damage here. You do have Treasury markets closed, of course, because Japan is shut. That's another thing that's going to add to the sort of illiquidity of this market and exacerbate the moves. And as Mark Cranfield was pointing out from our MLive team, London is also on a banking holiday, right? So we're going into a Monday where you don't have Hong Kong, Japan, and London to maybe smoothen out some of these massive moves we're seeing. The massive moves and some of the big stocks trading in Taiwan today, we're down about 2% on the benchmark last we checked. TSMC and friends on your screens, and this is having the sort of effect of this is an exporting market, and you have a massive move like this to the stronger side in the currency. It's going to have this intended effect. And I can tell you right now, going into the break right now, that the Taiwan dollar is up against everything right now. More on that in a moment. This is Bloomberg.
All right, it is all about FX here this morning, and particularly what we're seeing in Taipei. Look at the Taiwanese dollar here, surging another 4% and jumping the most since 1988. We're back to those two-year highs when it comes to this currency. A lot has to do with thin liquidity. We talk about the dollar hedging and what we're seeing in the FX and what we're seeing across traders as well. Let's kind of unpack all of this right now and bring in our managing editor for Asia Equities, Lanting Tu, in Singapore. Lanting, maybe you could tell us more on the equity impact on all this as well, but what really is going on now with these dollar moves, and what impact does it have really on stocks?
Yeah, it is quite a sharp move, and the stocks there are down quite a bit. I would say a sharp sort of underperformer in the region. Part of the concerns is that a strong currency would weigh on earnings of companies, and a lot of companies in Taiwan are quite reliant on export. So a stronger Taiwan dollar is certainly not good for their revenue or profit, and also for Taiwanese insurance companies, which hold a lot of U.S. treasuries. A stronger dollar again would translate into less return for these companies, and they also have a big weighting on the index. And then also, if you look at TSMC, which has the biggest weighting on the index, and that company is very reliant on export. I believe about 70% of its revenue comes from abroad, and a stronger dollar, I would say a 1% of strengthening in the Taiwan dollar would translate into 0.4 percentage point in margin impact for the company, and that is according to some local media estimate. So overall, I think a lot of Taiwanese companies suddenly come under pressure because of the stronger Taiwan dollar.
Lianting, I'm sure your team is right now trying to reach out to people in the market, if not already. What's the sense so far, though, you're getting in terms of the analyst community? What are they saying about what's taking place right now? Give us some color there, if any.
Yeah. I think a lot of people are doing calculations right now about Taiwan dollar's impact on profit margins and revenue impact for all these Taiwanese companies. So that calculation is underway. TSMC obviously is a key index, a key stock that people are doing calculations on, but Taiwan has also a lot of electronics exporters like Hon Hai, Pegatron, and all these companies. I think investors will have to recalibrate calibrate the kind of profit outlook for these companies if the Taiwanese currency continues to strengthen. And also, there is little sign that the central bank is stepping in right now. So that is also part of the calculation. Will they or will they not step in anytime soon?
Lian Ting, thank you so much there. Last minute reporting there coming through out of our team there, really getting us up to speed on this breaking news story coming through out of the markets here in Taiwan. That's the equity complex here. Just to underscore really how generational and, 3 sigma this move is that we're seeing right now. Let's put it that way on a Z-score. So this is the Taiwan dollar against all of its peers right now. And, the one that's actually doing, holding up well right now is a 3% drop in the ringgit against everything else. It's a scale basically across that spectrum all the way down. Right. Now on the equity market, right, the components that Lian Ting was just pointing out right now, here in the Bloomberg we have this function which takes you through some of the sector movers right now. So as you can see, it's really a bad day to be in the Taiwanese equity market right now. We showed you some of that. Right? In particular, you see that really bright hue of red right now. That's the financial, that's the insurance space over in Taiwan in terms of the exposure, the hedging costs, and they weren't able to hedge it. What we might see there mark to market as far as the financial impact is concerned. We're down about 400 points there, Yvonne, on the TAIEX index.
StoneX had some pretty interesting calls on this out in Singapore. Ming-Tzu Wu was saying that, if you're exposed to the dollar without any hedging, certainly it's going to be a painful ride as well. But key to watch is the hedging strategies as a key driver of the Taiwan dollar moving forward as well. We'll kind of put a pause on this right now and get a check on what's going on in headlines around the world. South Korea's ruling People Power Party has selected former Labor Minister Kim Moon-soo as its presidential candidate. Kim will be up against opposition nominee Lee Jae-myung, who is leading opinion polls ahead of next month's election. But the Supreme Court last week found Lee guilty of violating election law, casting a shadow over his campaign. Australian Prime Minister Anthony Albanese has won a strong mandate to overhaul the nation's economy. His Labour Party was returned to power in Saturday's election with an increased majority as voters rejected the Trump-style populism of the Conservative opposition. Albanese's center-left government now has the best chance in years to take the hard steps economists have called for to ignite growth.
Right. Now, let's talk about Singapore and elections right now. So you had the ruling party there, of course, also securing a fairly convincing victory and win over the weekend in the first electoral test here for the Prime Minister Lawrence Wong since he took office about a year ago. So you had the People's Action Party winning 87 of the 97 seats up for grabs in Parliament. That's on Saturday. Let's bring in Ja Ian Chong, Associate Professor of Political Science at the National University of Singapore. Ian, good morning and thanks for coming on the show here. Were you surprised?
Not really. I think the seat share, the PAP, they basically would have formed the next government anyway. They would have the supermajority anyway. I think the little bit of surprise was the increase against a lot of the other opposition parties. But the Workers' Party, interestingly, they managed to actually increase their number of seats from 10 to 12 for the 2 NCMP seats. So the PAP did well, but not as well probably as some might have hoped. Lawrence Wong does have a clear support and clear momentum going in, and we'll see how he can push Singapore forward as we enter the next parliamentary term.
Yeah, maybe tell us a bit more about that strong mandate. What can he do with it now? How is he going to execute, and what are going to be the priorities moving forward, Ian?
So Lawrence Wong, going into the election, had talked about how Singapore needs to navigate more uncertain waters, that it needs to set itself a new direction. He's talked a little bit about rejiggering the economy. He's talked a little bit about trying to find new markets, new opportunities around the world. He didn't give much details before. I suppose what will be on his plate now is to work out those details and to sell that to the public and tell the public, well, these are the things that you have to do. These are some of the sacrifices we have to make so that we get into a better place. So I guess we're all waiting for him to lay those plans out.
And Ian, what does this mean for foreign companies in Singapore, particularly foreign workers in Singapore?
So the PAP will largely continue their approach to foreign labor, meaning to say that they will continue to try to take in more professionals. They will continue to take in low-wage migrant labor. There may be some adjustment here and there, but largely those policies will stay. For foreign businesses, I guess that means they would have to watch how Wong handles the tariff and trade war situation. And that bit actually, prior to the election, I was surprised that there wasn't a clearer plan. They put in a task force a few weeks before the election to try to handle this situation, but we have not yet seen any sort of concrete deliverables or any concrete direction. We know that there's been negotiations with the U.S. The U.S. has refused to sort of move away from the baseline tariffs. They're open to other negotiations, but we don't know what those look like yet.
Can you tell us a bit more about what the social welfare push as well, Ian? Because leading up to this election, there was this kind of growing narrative that the opposition was gaining some clout because of their, I guess, concerns around how the PAP has addressed the cost of living situation in Singapore.
Right.
Do you think that Singapore can afford to continue on these vouchers?
So that's a big question. I guess the opposition parties had been pushing for a more sort of comprehensive reform to the social welfare system. Now, the PAP has sort of resisted that and said, well, doing vouchers is sufficient for now. So I guess the question is, what is more sustainable for Singapore, whether you move to a more social welfareist direction to sort of sustain the population as costs increase, as income and wealth disparity increases, or do you think that whenever the need arises, you can give a voucher? So those are two distinct arguments. For right now, it seems that the public is satisfied or at least mollified with the vouchers. Whether that can persist and whether that puts pressure on the Wong government going forward, I think remains to be seen.
Yeah, Ian, I mean, the PAP has been has held power for, let's call it decades now, and I'm wondering, is there any reason to believe that they won't be pragmatic if the time came to take on some of the suggestions and recommendations from the opposition, is what I'm trying to get to. In other words, vouchers for now, but is there any reason to believe that they won't take the alternative if that is the proper prescription here for the economy?
Right. So the PAP, like any other political party, wants to stay in office. And if there is really a sustained demand from the population, I can see that there will be more reforms. In fact, some of the language has somewhat shifted. They've been more willing to entertain the idea of something akin to an employment insurance system floated by the Workers' Party before. They won't give credit, of course, but you can see those ideas slowly shifting. So that suggests to me that the primary sort of consideration for the PAP business is important, but it really is the voter base. So they will make the adjustments. I think they'll try to calibrate between business needs and also what their domestic political needs are.
Ja Ian Chong, thank you so much for joining us, Associate Professor of Political Science at the National University of Singapore. Well, coming up, we're speaking with former movie industry executive Steven Wolfe Pereira to discuss President Trump's latest order to restrict the entry of foreign films into the U.S. That's next. This is Bloomberg.
Right, welcome back. An update here of this massive move in the Taiwan dollar. This is really coming on the back of just this, well, a lot of things. Imagine getting on a long-haul flight and just thinking, I'm going to exchange my money when I get there. And then you get there, and then this is what the exchange rate looks like. The benefit of hindsight. But yeah, I mean, if you're an insurer, it's probably something you have thought about, really. But yes, but it's a massive move we're seeing right now.
Yes, and we talked about the kind of cocktail risk around this and what's driving these massive, unprecedented moves, right? You talk about having liquidity issues here, given that, Japan's shut here. You're talking about, the FX markets are basically asleep right now. So that might be exacerbating a lot of the moves. But really, what life insurers, what corporates are doing in terms of hedging activities now, that is going to be the key driver, some say, of where the Taiwan dollar is going to go moving forward. But yeah, as you talked about, right, we're sub 30 now for the currency.
Yeah, in fact, okay, so some of the commentary coming through as well. So this is the equity impact of this as well. So we had from StoneX talking about how some of the mechanics around the currency markets. The comment from the head of institutional equity sales at Maybank Securities now coming out is the local chatter is that the rally we're seeing in the Taiwan dollar is now may affect 2Q earnings via the FX translation. In other words, TSMC, if you're not hedged, TSMC maybe as an example of how this might translate into the broader sort of Taiwanese corporate space. If you're not hedged, you're probably going to realize this in the form of just a massive FX loss if you didn't take the other side of that position, right? And I think the question that we actually asked earlier on, Joey Chu, who is head of Asia FX Research at HSBC, talked about how, you know, if you believe, okay, do I hedge now? It's a question. And do I pay 7% to hedge, but do I believe the Taiwan dollar has further 7% to go? It's a really difficult situation right now. But these are difficult questions given that this was such a move that wasn't expected going into this Monday, Yvonne.
Yeah, and I think the key question is this kind of de-dollarization trend. Is it something that's structural? Is it just a short-term phenomenon?
Yeah.
You're certainly seeing that pressure among exporters now amidst the sort of dollar selling wave that we've been seeing. Certainly want to watch here. We're going to move on and continue on what's been going on in this trade war as well. The latest this morning that we heard from President Trump says that he's planning to impose a 100% tariff on movies produced overseas. And the move will extend his restrictive trade policies on U.S. imports to the entertainment sector for the first time. Still a lot of questions, though, on how this is all going to work, how such works duties would be valued for tariff collection purposes, for example. And many films, as we know from Hollywood studios, involve global production. Joining us now is Steven Wolfe Pereira, CEO of a AI governance intelligence platform, Alpha. He was also formerly the chief client officer with Univision and the chief business officer of 3PAS Studios. It's great to have you on the program, Steve. I kind of get your take on what we heard from President Trump this morning on that headline. Is it surprising to you that we would see tariffs being hit in Hollywood now?
So thanks for having me. And it's not surprising. You know, the reality is we're seeing the rise of protectionism across all U.S. industry. And the whole notion of trying to have things made in America sounds good in theory, but in practice, you actually have a whole economic market that is truly globalized. And it's so difficult to kind of put that genie back in the bottle. And obviously, Trump is trying to do that with these tariffs. But when you look at the way that, you know, the global entertainment industry functions, so much of the industry is actually done abroad. Certainly, a lot of things are made in America. But when it comes to production and VFX, it's just really hard to imagine that you're going to be able to stop global production.
Stephen, David here, is there a broad common agreement of how we define a foreign-made film, for example, just as a starting point?
Well, you know, the reality is so much of filmmaking today is actually made in America, whether it's the writing, whether it's the design, whether it's, you know, just kind of the whole concepting of the beginning of the pre-production process. That's actually done in the States for the most part. You know, but when you think about, you know, global productions, when you think about locations, and certainly a lot of the VFX, some of that stuff is actually done abroad. So, you know, for me, it's really just trying to understand what really is behind this. What is the economic incentive to really kind of put, you know, kind of made in America first, when you actually see U.S. in film, TV, and production was down over 40%, you know, throughout 2024. And, you know, coming back off the, you know, kind of the strikes that we saw in Hollywood, you know, it just really seems, you know, kind of short-sighted to say, you know what, we're going to put tariffs on something that truly is a digital good in this day and age.
Yeah, I mean, obviously he's doing the same thing when it comes to bringing manufacturing back to America. Movie making in America and keeping it at home. How difficult is it to kind of just make this kind of global supply chain of movie production back into domestic waters in some way, Stephen? I'm just trying to fathom kind of how difficult is it to implement this, and are these tariffs going to be effective enough?
So I think you really have to break down what are the functions that we're talking about. Again, whether it comes to the writing, whether it comes to the concepting, you know, the design, a lot of that stuff is actually being done in the United States. But when it comes to the actual production, you know, when you think about the task, you know, whether it's filming on location, you actually have a bigger threat, which is actually the rise of AI. You know, AI is actually quietly replacing over 20% of production roles today, regardless of where cameras roll. And so I think the real disruption is not geographic, it's actually technological. And that is something that we should be looking at.
Right. And I mean, Stephen, I was going to ask you then, how is the industry doing these days?
I mean, obviously, the whole industry is in structural decline. I mean, no one really wants to admit it, but there's a huge kind of a fear that's happening in Hollywood, and a lot of people equate it to the auto industry. I mean, is this the hollowing out of Hollywood? And when you see the rise of the creator economy, I mean, I'm on the board of an incredible creator company called Whaler. When you see the rise of where people are actually kind of spending their time for entertainment, it's actually a lot more threatening to see the rise of TikTok, which actually consumes 95 minutes a day, regardless of traditional theatrical windows, and to see the kind of collapse of that go from 90 days to 17 days, the whole rise of digital technologies, alternative means of entertainment, those are much bigger threats to kind of the traditional Hollywood ecosystem.
Right, and I'm wondering if if we're barking up the wrong tree here, right? So the immediate reaction that we had here in the newsroom when we saw the headline coming out of the U.S. president was maybe this was, again, to the point, an economic solution that brings some of the production back. Is there a geopolitical sort of overlay of China restricting, say, the access of Hollywood studios to that market? And I wonder how does geopolitics actually affect the industry right now? In what way do you think is that most pronounced?
I mean, the geopolitical factors to this cannot be ignored. Obviously, China is at the crosshairs of all of this, and we really are seeing the whole idea of understanding how foreign films are production, kind of abroad is a national security threat. I just think that's bogus. I mean, it obviously is a red herring. Certainly, there are tax incentives across the globe that are incentivizing folks to go to everywhere from New Zealand to Spain to Mexico, all throughout Asia. And so how do we actually reduce regulation? How do we actually incentivize people to come and actually make movies in America? I believe that deregulation is a much more encouraging approach to economic, kind of policy versus really trying to impose tariffs and trying to force people to come here because it's so expensive to do it, to obviously, just think about the whole macroeconomic landscape. It is so much more compelling to actually incentivize people to come here because they want to, as opposed to forcing people.
What a point. Yes, absolutely. Stephen, and to your other point too, right? The focus on AI and tech is something that, again, I guess because of this, we now need to talk about, and rightly so. Stephen, fantastic. Thank you so much for taking the time to speak with us here. Steven Wolfe Pereira, the CEO of Alpha. Okay, watch this space. Plenty more ahead. This is Bloomberg. All right, welcome back. You know what? So here's how we started out. Here's at least how I started out my day. I woke up this morning and I was like, oh, Yvonne's coming back. Fantastic. It's going to be a nice day. We're going to ease into the week.
Markets are closed.
Markets are closed. A lot of markets are closed. Yeah. The biggest story was an oil, which is still a big story.
It's
the oil price.
We barely talked about it, though.
and then that happened. See that? The second ticker? That's a move you don't normally see in the equity market, let alone the currency market, right?
Yeah.
And the Taiwan dollar, I think they waited for you to come back.
Yeah.
For this dislocation to take place.
Yeah, it's crazy. We're seeing it across most Asian currencies,
That's
as
right.
Joey Chu from HSBC has said. But we're really seeing it being channeled in the FX markets in Taiwan. Part of it maybe is the growing optimism around trade talks that maybe intensified a lot of the dollar selling from exporters. That's what some traders are saying here right now. That's why we're seeing these outside moves. But there's also that less forceful central bank intervention or that presence in the FX markets that might be kind of fueling a lot of this as well.
And as Mark was pointing out, they're not in just yet today, which is, I guess, another thing to consider in terms of intervention today. But, we've seen intervention from the Hong Kong Monetary Authority. And, the other thing that Yvonne was pointing out is, you don't have markets. Major markets are shut today, right? So usually when you would see London pick up from Tokyo, you're not getting that today. In fact, Hong Kong is also shut. So you don't have the vast majority of markets and trading that's shut today. So this could actually be worse. If you think about it, the moves will probably get very dramatic moves today. It'll probably be worse tomorrow when we get onshore markets coming back online in China and what that fix looks like and how things are probably going to be anchored. But yes, this has many, many facets to it.
And you got to wonder, right? The equity market has been pretty, bountiful, right? I mean, we've come back from basically the losses that we saw since Liberation Day, right? And basically you're seeing that in the treasury market as well. Does the FX volatility sort of spread to some of the other asset classes is going to be the key issue here, especially when it comes to this 9-day rally we've seen in the S&P? Generational rally. Really, I think that's a word we keep using today. October 1989 was the last time we actually had a 10-day streak. We could still get that. We could still get that today. But as you know, as the ominous moves we're seeing in the FX markets plays out, you know, what happens in the FX markets doesn't tend to remain in the FX market. So watch this space very, very closely. Yep, that's it for us here on the China Show. We have Insight with Heslina Amin. What's coming up next? Stay with us.